Benjamin Graham, known as the Dean of Wall Street, penned The Intelligent Investor, a book that has become the Bible of value investing. Its significance in the finance world is immeasurable, and its principles remain relevant, even in the ever-changing financial landscape of today. Its impact is evident in the success of investors like Warren Buffett, who swear by its teachings. This book isn't just a guide, but a financial philosophy that has shaped the investment world. At the heart of The Intelligent Investor is the distinction between investing and speculation. Picture the financial world as a bustling marketplace. In one corner, you'll find the investors, those who meticulously analyze their options, seeking out quality goods at reasonable prices. They're patient, disciplined, and they play the long game. On the other side, we have the speculators. They're the thrill seekers, always on the lookout for a quick profit, often driven by rumors, trends, or gut feelings rather than thorough analysis. Benjamin Graham, the author of The Intelligent Investor, described investing as an activity that, upon thorough analysis, promises safety of principal and an adequate return. In other words, true investing is about making thoughtful decisions to ensure your money is safe and will yield a reasonable return over time. Speculation, on the other hand, is quite a different beast. It's more akin to gambling, where the possibility of high returns is intoxicating but invariably comes with high risk. Speculators try to profit from market inefficiencies or short-term price movements. They're often swayed by the latest market trends and hot tips and are more likely to lose money in the long run. There's nothing inherently wrong with speculation. It can be exciting, and yes, sometimes it can be profitable. But it's not investing. Graham cautioned that if you can't tell the difference, you're not investing, you're speculating. The difference between investing and speculation isn't just about tactics. It's about mindset. It's about whether you're willing to put in the time and effort to understand what you're putting your money into, or whether you're just hoping to ride the wave of the next big thing. Investing is about patience and discipline. It's about understanding the intrinsic value of a security and buying it at a price that provides a margin of safety. It's about committing to a strategy for the long term and sticking to it, even when the market fluctuates. Graham's principles remind us that investing is not a game of luck, but a game of skill and analysis. So, are you an investor, or are you a speculator? Knowing the difference could make all the difference to your financial future. Meet Mr. Market, Graham's fictional character who is an erratic, moody fellow. In the grand world of investing, Mr. Market is a significant player. He's not a real person, mind you, but a metaphor, a character conjured up by Benjamin Graham in his seminal work, The Intelligent Investor. Mr. Market personifies the stock market's daily fluctuations, its unpredictable ups and downs that can swing from irrational exuberance to excessive pessimism in a heartbeat. One day Mr. Market is positively jubilant, offering to sell you his shares at a high price. On another, he's down in the dumps, ready to sell those same shares for a pittance. Mr. Market's moods are fickle and changeable, much like the weather. And here's where emotional discipline comes into play. You see, to be a successful investor, you can't be swayed by Mr. Market's moods. You can't panic when he's panicking, nor can you get carried away when he's on top of the world. The market is unpredictable, yes, but your investment decisions shouldn't be. They need to be grounded in sound analysis and rational judgment, not in the emotional whims of Mr. Market. Falling for Mr. Market's mood swings is a dangerous game. It can lead you to buy high and sell low, the exact opposite of successful investing. It can make you abandon your investment principles at the worst possible times, leading to losses that could have been avoided. So how can you maintain emotional discipline? By having a clear investment strategy and sticking to it, regardless of Mr. Market's moods. By understanding that the market's fluctuations are temporary, but your investment goals are long-term. By remembering that the market's job is to provide you with prices, not to dictate your actions. Yes, it's easier said than done, but remember, the best investors are those who can keep their cool when Mr. Market loses his. Remember, the market is there to serve you, not to guide you. Graham's concept of margin of safety is perhaps the most crucial takeaway from the book. So let's delve into this concept a bit more. Picture this. You're crossing a bridge that can hold a maximum weight of 10 tons. Would you dare to drive across it in a truck that weighs exactly 10 tons? Probably not, right? This is the essence of the margin of safety principle. It's about ensuring that you have a safety net in place. When investing, this safety net is the difference between the intrinsic value of a company and the price at which you buy its stock. If the intrinsic value of a company is higher than its stock price, you have a margin of safety. The larger this difference, the greater the safety margin and the lower the risk. But why is this margin of safety so important? The answer lies in the unpredictable nature of the market. The stock market is dynamic, with prices fluctuating due to a myriad of factors. The margin of safety acts as a buffer against these uncertainties. It minimizes the risk of loss by providing a cushion against errors in calculation or unforeseen market downturns. This isn't just about minimizing risk though, it's also about maximizing returns. When you buy a stock at a price below its intrinsic value, you stand to gain when the market recognizes this value and the stock price rises. So, the margin of safety principle is a twofold strategy. It protects against downside risk while offering the potential for substantial upside gains. At its core, the margin of safety is the bedrock of value investing. It is this principle that guides value investors in their quest for undervalued stocks, steering them clear of overpriced ones. It's about not just following the herd but making informed, rational decisions based on solid analysis of a company's true worth. So the next time you're considering an investment, remember the bridge analogy. Don't drive a 10-ton truck over a 10-ton bridge. Instead, ensure you have a sufficient margin of safety. Because ultimately, the margin of safety is the buffer that keeps the ship of investment from sinking. Graham categorizes investors into two types, defensive and enterprising. Let's dive into these categories, shall we? The defensive investor, as the name suggests, is all about protecting against losses. They prefer safety over high returns. This type of investor aims for a steady stream of income and avoids serious errors rather than scoring high profits. They stick to a simple, easy-to-follow, and consistent investment strategy. They are the tortoises of the investing world, slowly but steadily winning the race. But there's a flip side to this approach. The defensive investor's returns may not beat the market, and their overly cautious approach might cause them to miss out on potentially lucrative opportunities. But remember, their primary goal is not to win big, but to avoid losing. On the other hand, the enterprising investor is willing to put in more effort and take on more risk for the chance of higher returns. They actively seek out undervalued investments and are willing to delve deep into market trends and financial data. They're like hares, agile and quick, always on the lookout for the next big opportunity. However, this approach comes with its own set of drawbacks. The enterprising investor's aggressive strategy may lead to higher rewards, but it also exposes them to higher risk. If not careful, they could end up making costly mistakes. It's a high-stakes game where the risks and rewards are equally matched. In the grand scheme of things, there's no right or wrong approach. It all boils down to your personal investing style, risk tolerance, and financial goals. The defensive investor suits those who prefer a hands-off approach and are content with steady returns, while the enterprising investor fits those who are willing to roll up their sleeves and chase higher profits. Whether you're a defensive or enterprising investor, Graham's strategies offer a roadmap to financial success. It's all about understanding your investing personality and making it work for you. After all, the end game is to build a secure financial future. More than 7 decades later, The Intelligent Investor still stands unrivaled in its wisdom. This timeless classic has not only shaped the world of investing but continues to be a beacon for those navigating the financial markets today. We journeyed through the distinction between investment and speculation, understanding that the former demands thorough analysis, promises safety of principal, and an adequate return. On the other hand, speculation operates on the hope of a price increase, often without the safety net of a sound analysis. We then met Mr. Market, a metaphorical character embodying the volatile nature of stock markets. Graham taught us not to be swayed by Mr. Market's mood swings, but to maintain emotional discipline and make decisions based on intrinsic value. The concept of margin of safety was our next stop, emphasizing the importance of investing in stocks priced well below their intrinsic value. This principle, Graham suggests, offers a buffer against unforeseen market downturns. We also delved into the two investor profiles, the defensive and the enterprising. The defensive investor seeks safety and freedom from bother, while the enterprising investor is willing to put in significant effort for better returns. The legacy of the intelligent investor is profound, influencing modern investment strategies and inspiring many successful investors, including the likes of Warren Buffett. Its principles are deeply ingrained in value investing, a strategy that seeks to buy securities undervalued by the market. So, let's remember, as Graham wisely said, investment is most intelligent when it is most businesslike.